Hey, what's up guys? This is Channing Moore, the broker owner of Bayou Mortgage. In today's video, I'm going to give you the juice on how we flip denials into approvals every day at my mortgage company, Bayou Mortgage, and why you being denied by one lender doesn't mean you're necessarily going to be denied by all of them. And hey, if you haven't been denied, here's a little secret into how we help people who have more challenging credit pasts or various things going on with their life. So like I said, what we're going to jump into, and we're going to share you exactly how we convert those denials to approvals every day. And the first thing you need to understand is the process that your lender goes through in order to determine if you qualify for a home loan or not. And so that process is going to go through something called an automated underwriting system, or AUS for short. Now what this automated underwriting system does is it takes the information you put on your loan application and it processes that information. It's an algorithm basically, and it tells the lender whether or not that your loan is approved or not. Now, if you're feeling like, hey, that's not fair, I don't want some computers telling me if I buy a home or not, luckily for you, the juice of today is known as a manual underwrite, which is the opposite of the automated underwriting system. And we're going to get into that in a minute. But for the automated underwriting systems, you have basically three primary different systems. Desktop underwriter or originator, depending on if they're a broker or a lender. Freddie Mac, loan prospector system, and then GUS, which is the system that we use for USDA rural development loans. Now, all three of these systems are going to do the same three things. And this is one of the biggest reasons why it's important that you give your lender accurate information on your loan application, because if those things vary, then the findings, which is what they're called, that we get will not be as accurate as they should be. And so this is why you'll see a good lender. Now, your online lenders aren't doing this. They're just telling you you're approved without looking at any of this information. They've basically handed you a ticking time bomb and you don't know when it's going to explode. But if you've had a troubled past, or you've got some credit issues, or you've got some income issues, it will blow up. This is why good lenders get documents, because the documents back up the information you put on the application. And we don't think most people intentionally lie to lenders. You just don't know. But we do. And so we can take that information and find potential pitfalls that you didn't even know existed. And so when we look at those documents, it helps us to interpret the data that you put on the application, because the findings that we get are only as good as the data that we have. And so if anything changes, this situation is fluid, it can change in the future. But the manual underwrite gives us the opportunity to tell more of a story. So if you're thinking, man, that sucks that like a computer is going to determine my future on whether or not I buy a house, lucky for you, there is an opportunity to avoid that, or if you don't qualify for that, to still purchase a home based on a couple of different things. And it's called a manual underwrite, which is the opposite of an automated underwrite. Now, with a manual underwrite, the FHA, VA, and USDA loan programs give us the ability to do this, and they give us the ability to tell a story. In fact, many times these loans are called story loans. Now, the reason these loans are called story loans is because they give us the ability to tell more of a story about what's going on in a person's life, other than just what their credit report and pay stubs show. When it comes to a manual underwritten loan, there's a few different things the lender is going to look for in addition to the traditional requirements. And it is going to be a tougher process. It is going to be a more document-laden process than even the traditional mortgage process is. But if you can commit to that and stick with it, then a lot of times it will yield fruit in the form of you being able to purchase a home. So some of the additional requirements that the lenders are going to look for are things like compensating factors. What those compensating factors typically look like, or residual income. This is discretionary income left over after your bills every month. It has to meet certain thresholds depending on the loan program. This looks like cash reserves. These are mortgage payments left over after the closing process. This could be rental history, meaning, can you prove that you paid your rent on time for 12 months? Many of the loans, FHA, USDA for sure, require this as a result of doing a manual underwrite. This could be no payment shock. So is your price, how much is your monthly note going up in comparison to your current rent amount? It could also be something like extra income not being used on the mortgage application. Let's say that you're married and you have a spouse, but your spouse's credit is not in a place where it's going to qualify to be used on the loan, so we're not using their income. Well, we can use that income for a quote-unquote compensating factor. So it won't reduce your debt to income ratio or anything like that, but what it will do is prove a compensating factor. Now, why are compensating factors important? Well, for one, because things like cash reserves and rental history, they're going to be required no matter what. But other compensating factors are going to give you the ability to exceed the minimum debt to income requirements. So when you go down to a manual on, say, like an FHA or a VA, or actually even USDA, they all kind of have the same number of around 41% restriction on your debt to income ratio. But each of them, except the USDA, are going to give you opportunities to exceed those debt to income thresholds with compensating factors. And so if you have two compensating factors and you're doing a VA loan that's a manual underwrite, well, one of our lenders will allow us to go up to 50%. And it's pretty much the same way with FHA. So having these compensating factors is the juice in being able to turn a denial into an approval. So what is a cash reserve? This is one that we talk about a lot because it's one of the requirements. Now, a cash reserve is simply this. It's 1 month of your mortgage payment saved up in a bank or a usable source, bank, retirement funds, has to be your own money, can't be a gift, left over after you've paid your down payment and closing costs. Now, the good news about this is that with USDA, you don't have a down payment, and you're oftentimes getting your closing costs paid for by the seller. VA and FHA can be the same way, except with FHA, you're either paying for your down payment or you're getting a gift from someone to cover that down payment. So the cash reserves is going to be 1 month of your mortgage payment left over after everything is said and done. Now, with FHA and VA, they say as long as you have 1 month cash reserve, you're usually okay, although more may allow you to exceed those DTI thresholds we were just talking about. With USDA, because there's no down payment requirement and there's no veteran benefit attached to it, they want 3 months cash reserves. So if your mortgage payment was $1,200 a month, you would need 3 months of that, which is $3,600 saved up in a bank or in a retirement fund somewhere, and this is where it really gets good, and you would need to show that you have that after everything was said and done. Now, the reason this is great is because this isn't money you have to spend. So you don't have to write a check to the bank for $3,600. You just have to prove that it's there. You get to keep the money. It's just that rainy day fund that tells the lender, hey, if I approve this loan, even though the computer's telling me not to, they've got some backup runway here to make that mortgage payment if they were to get in a bind or if something was to come up or things were to happen. Because as you may well know, buying a house is a pretty expensive event. So that's what a cash reserve is, and it is required on all 3 loan programs in order to do the manual underwrite. Rent verification is exactly what it sounds like. Rent verification on USDA and FHA are typically a requirement, and we have to document that you've paid your rent on time for the last 12 months, and that information must come from your landlord. Now, one caveat is that if you live with family, they can write a letter stating that you live with family, and many of our lenders will accept that. So if you're living with family or someone other than family and they'll write that letter, then we can get around that 12-month requirement a lot of times to document that you've got the rent history because you're not renting, you're living with family. Now, as far as the your rent payment and it not being too much, what they say is that as long as your payment doesn't exceed 25% of what you're currently paying in rent, then you can also use that as a compensating factor. So those are just 3 of the most common ones that we typically see. The other ones I kind of talked about and shared. But this is the juice, guys. This is how we are able to convert those denials into approvals. This is how we're able to take someone with past credit history, past credit issues, or other things and turn them into approvals. Not every lender does these. And so that's why when you call big banks, when you call online lenders, when you call your little community bank, most of them are not going to do these. Credit unions too. They're not going to do manual underwrites because they're time consuming, and they are, and they don't have the capacity to do them, and so they just tell you you're denied. And then you're left thinking like you have no other option, you got to work on all these things. But the truth is that even though you have been told no by them, that you can still actually purchase a home a lot of times as long as we can check off some of those additional boxes. Now one important thing I want to note is that a manual underwrite process, and I already said it, is tougher. You got to do a lot more explaining, you got to provide a lot more documentation, and really, you as the buyer, you have got to be patient because it is a longer process, not much longer, and sometimes not any longer, but it's really about how quickly you can get these things that the underwriter is going to ask for and answer the questions they're going to ask. And a lot of times people get frustrated. They're like, why do they need to know this? Well, this is, stupid, or there's a lot of the different things we hear. But understand that there's an end goal in mind here. And so it may be a little intrusive, it may be a little frustrating to be having all these questions asked to you, but at the end of it, is a home you get to own, a home of your very own. And the really cool part is that most of our lenders don't add rate adjustments. So you're not going to get a higher rate just because you're a manual underwrite versus an automated underwrite. You're still going to get the same rate either way. So just keep that in mind if you're considering doing this. But I wanted to share with you how we're able to do these things for so many clients when they've been told no or rejected by other banks. And if you feel like that's you, or if you know you've got prior credit issues, working with a broker who's got access to these types of banks could be the difference between you continuing to pay your landlord's rent or mortgage, or getting to pay a mortgage of your very own and getting to own a home of your very own. So anyways, I'm Channing Moore. I'm the broker owner. I really appreciate you taking the time to check out this video today. If you think we can help you, there's going to be a button somewhere around this video that says see if you qualify. You can click that. You can schedule the call with one of our team members to learn more about your unique situation. We're not really here to sell you. We just want to hear about your situation so we can interpret that for you based on what we know about the mortgage industry and tell you if there's products that you can qualify based on what your particular situation is. So look forward to talking to you guys next week. Let me know if you have any questions.